Hello and welcome to Dukas Copy TV's weekly wrap-up. I'm Louise Macaulay and joining me on the line to discuss the week's past events is Andrew Wilkinson, Chief Market Analyst at Interactive Brokers. So Andrew, Japan missed its estimated GDP growth of 3.7% this week. Nevertheless, it did grow 2.2%. So could you tell us what the initial market reaction was and how it has progressed throughout the week?
Well, initially investors were pretty disappointed with Japanese GDP growth, naturally coming in below forecast. What it really tells us is that the Japanese economy probably requires further stimulus from the Bank of Japan. And I guess the biggest question mark overhanging that is whether or not massive quantitative easing at the BOJ is actually working for the domestic economy. The weakness in the yen that is anticipated or has filtered through as a result of QE does seem to be boosting growth, but we seem to have somewhat of an anemic recovery. So we're seeing export gains as a result of a weaker yen, but still fairly anemic in investment and investment spending and domestic consumption. So I think as the week wore on, what was initially taken to be negative in terms of the yen, we saw yen strengthening to around 117.5. We've seen kind of a greater weakening or resumption of that trend of a weaker yen as the weeks wore on. So we're about heading towards 120 versus the dollar. So that looks like if the market is getting back into that mode of expecting further stimulus, one would expect the yen to continue weakening into the 120s.
Now, taking a look at other major market movers, what stood out for you this week and why?
Well, there's a couple of things that moved or didn't move this week, more to the point. The first one is what's going on with the negotiations with Greek and its loan extension. What's really happening here is kind of there's real inaction. The euro hasn't really weakened as a result of this concern of the Greek exit, known as the Grexit. I'm of the opinion that whether Greece leaves the EU or is forced out by particularly Germany is not really as a significant a factor as it has been, say, a couple of years ago. 2012, Spanish and Italian equity markets put in their financial recession lows some 4 or 5 years after other global benchmark indices. And what's happening today is we're going through the Greek bailout negotiations or the extension of those terms. We're seeing global stock markets, including Europeans, at all-time highs. So there's a real difference of attitude compared to a couple of years ago when Greece really was threatening to be pushed out and probably to drag other members out with it. So it seems to me that nobody really cares, and we've already had a massive weakening of the euro currency against other majors, particularly the dollar, because we're at different times of the central bank cycle. So the US is more likely to raise interest rates, tighten monetary policy, where the ECB has just embarked upon extending its QE. So the whole issue of Greece seems to be not really playing significantly into the value of the euro. So looking forward, I think perhaps when this blows away, we should expect the euro to rebound. We've seen a big increase in activity in the eurozone, probably because the euro was weakened significantly, and so that's possibly playing into helping the appearance of QE working. The other major event this week was a strengthening of the pound sterling against the dollar, when the dollar was really ramping up against other major currencies. Of course, the dollar really stood still against the euro, but what was notable was the strengthening of sterling following the release of the MPC minutes and also the labour market data. So the ILO version of unemployment fell to 5.7%. That's the lowest in several years. But even with the bigger, most important component of that report was the average earnings numbered around 2.1%. I think it was. That was the biggest margin in about 6 years. over the core rate of annual inflation, which is down at 0.3%. So we've got that big disparity, and what the Bank of England is saying is basically we really expect inflation not to remain down here, which is energy inspired, and as the year turns to 2016, given the health of the labour market and the assumed continued strength of it, we would expect to see interest rates going up. So that's supporting somewhat the pound, and certainly making it a standout relative to anything else.
And what should we be keeping a close eye on in the coming week?
Well, we've just had the minutes from the FOMC, which kind of disappointed expectations that Janet Yellen and crew would be preparing the groundwork for a June interest rate hike. I still think that's probably on the cards, but coming up shortly will be her semi-annual testimony to Congress. And I think what's really important here is that the minutes of the January meeting came ahead of another strong unemployment report, the non-farm payrolls report, with its revisions showed that in the latest 3 months, the U.S. economy created just over 1 million positions, and that was the strongest reading since 1998, or even perhaps the year prior. So when it comes to, there's probably going to be some subtle difference between the tone of the minutes, particularly as the international events are playing out the way they are. They don't appear to be as threatening as they formerly were at the time of the January meeting. So I would expect Yellen to perhaps wax somewhat bullish about the prospects for the U.S. economy. Clearly, the labour market's moving further forward, and that's got to be bullish for the dollar. So I think we've got to watch what's happening for U.S. yields. The yield on the 10-year note has risen by about 50 basis points since mid-December, and that's purely on the grounds of the fact is that stock markets around the world are moving to new highs. The perceived demand for safety in treasuries is clearly waning, and as I mentioned earlier about the situation with Greece, that seems to be far less of a threat. So. It seems that we've still got to watch what's going on with the dollar and how that's affecting everything else. We've also got some key economic data in the U.S. Next week with durables and durable goods data, consumer price index, and consumer confidence. All of those could be significant drivers of demand for the dollar.
Well, thank you very much for your comments, Andrew. Well, that is all from me for today for the weekly wrap-up, but the Dukas Copy TV team will keep you updated with economic news and exclusive interviews throughout the day. Goodbye for now.